Welcome back to the channel. This is another Wall Street Wednesday, and for the first one, y'all didn't really like it or didn't watch it. So this might be the last one that I do. I might just make them Patreon supporter only for those that like this kind of stuff. But there's been a couple of interesting developments in terms of recent articles, mainly one that I wanted to talk about, and it relates to what's called the wealth effect. This is something that we've talked about with Star Wars collectibles or collectibles in general, especially during the COVID market era for collectibles, and how there was a lot of money floating around, a lot of free money floating around with people that are locked in with nothing to do. So they spent it on collectibles, prices rose. We got to some pretty insane valuations for a lot of different collectibles. And a lot of it can be contributed to what's called the wealth effect. And the current Treasury Secretary, Scott Bessent, he had a Wall Street Journal op-ed that came out last week that basically blasted the Federal Reserve. And I tend to agree with what he had to say. And I'll present all sides. I'm not, this again is not a political discussion. But I want to talk about what is the wealth effect for those of you that don't know. What has the Fed done over the last 15 to 18 years to create the wealth effect? What are some of the past Fed chairmen's, the Federal Reserve chairman's comments about it, the positives and the negatives of the wealth effect, and where are we right now? And I think that you'll find that we're kind of in the era of F around and find out. I think that that's where we are right now, based on what the U.S. dollar has been doing over the last 6 months, and really quite a bit longer than that. And so before I dig in, I want to say I apologize. I've got a Band-Aid on my head. I had an adverse reaction to some almonds, and it made my face just blow up, if you haven't noticed in some of my recent videos. So I cannot get this thing to heal, so I'm putting a Band-Aid on it to see if it'll help. I look like I got mugged, and that's fine. I don't really care what I look like, but that's what is going on with that Band-Aid. So I want to talk about this because I think it does relate to the collectibles market, and it's stuff that I've kind of tiptoed around this in lots of other videos, not just financial videos, but other videos as well. But it's a real thing. And so let's talk about what's called the wealth effect. And it's basically, I pulled up the AI version of it, but it does a pretty good job of explaining it. The wealth effect is a behavioral economic theory. That's the key word, theory, that describes how consumers increase their spending when they feel wealthier due to a rise in the value of their other assets, such as stocks, real estate, crypto, you name it, right? And this feeling of increased wealth and financial confidence can stimulate consumption even without an actual increase in disposable income. Well, we had kind of a double whammy, right? We had an increase in disposable income during the COVID market era for, the bubble that we saw. And people were also decreasing their discretionary spending on other things like travel, like live concerts, like going to restaurants, because we were all kind of locked in during the COVID era. So we had a double whammy during that. So that's why we saw some of the crazy prices, increased demand for collectibles with an increase in disposable income. The wealth effect is really this is not really a change in your paycheck, right? But because your house is now worth way more, because Bitcoin is worth way more, or whatever it is, your stocks, whatever. We've talked about the really high valuations in the stock market recently because of the artificial intelligence boom that's going on. Well, all of that stuff can contribute to make people spend more on other things. And that's exactly what's going on, I think, to a certain extent, right? The housing market is just completely out of whack right now because valuations are so high. Sellers don't want to sell for lower valuations because they see some of the other prices that have happened historically over the last 18 to 24 months. And buyers don't want to buy because the current mortgage rates are up, although they've come back down here recently. So how it works and its economic benefit. The wealth effect is driven by the perception, that's the key word, of being richer, which boosts consumer confidence and leads people to spend more freely and save less. This is a good point, is that this feeling is often tied to unrealized gains. We're not selling our house. We're not going and selling our 401k, but because they've gone up so much in value, we feel like Mr. Moneybags, and it's time to go buy some crap. That's basically what it is. And the macroeconomic impact is that it does stimulate economic growth on a macro scale, right? Because people are spending more money, more tax revenue for the government. And people who are selling stuff, they're getting big valuations for it. This was absolutely true for me. I don't know how much I've told you guys this, so I apologize if I'm repeating myself. But, I sold a commercial building at the end of 2023 for a 600% return on what the original purchase price was. 600%. And it was very tempting to fall into this wealth effect, because I had a huge windfall that was somewhat expected, but somewhat not. I didn't know if those numbers, those unrealized gains that are mentioned here, were actually going to be realized gains or not. But we kept getting hounded to sell this office building, and the timing finally was right. And it turns out it was the right decision, because the real estate market has not done well, especially the commercial real estate market, which is what this was. It was a commercial building. The commercial building, after I sold that, has really gone through the floor. I mean, we've had some major pain in the commercial real estate market. So my timing was great. I would love to say it was because of intelligence or because I'm so smart and, oh man, I just know how to time the market. No, that's not what happened. It was pure luck, okay? It was absolutely pure luck. But I could have fallen into what's called the wealth effect, and I could have started just spending willy-nilly. We had to go buy a new car recently. I could have dropped a lot more money than I ended up dropping on a new vehicle. But because I'm so pragmatic with my money, we ended up buying a vehicle that was well below what we could afford, but I'm perfectly happy with it. It gets me from point A to point B. I don't need a $100,000 vehicle, right? So why not buy a $30,000 vehicle that is basically brand new, not new, and that has a good performance history and very reliable, things like that, very safe. So that was, and my kids were pushing me. It's like, Dad, we know you want that fully loaded Ford Bronco, brand new Ford Bronco. Why don't you buy that? No, because you guys are 13 and in 5 years you're going to college. So I'm going to have some big boy expenses coming up. So it could have been very easy to fall into this psychological trigger of the wealth effect, because not only were they unrealized gains, they were realized gains. But I fought off the temptation. But a lot of people don't. And this is basically what it is this wealth effect and people spending money based on their unrealized paper gains. Well, Wolf Street, which is a website that I follow regularly, I told you about it all the time. It's free. You sign up for the free newsletter. They do a really good job of summarizing the Treasury Secretary Scott Bessent's op-ed in the Wall Street Journal, and he basically let the Fed have it for their historical stupidity of ZIRP, zero interest rate policy, or near zero. And because the Fed has kept rates, the federal funds rate, which is the borrowing rate used to basically drive short-term borrowing costs for everything else, because they kept it for at near zero for 17 years, basically, since 2008, the great financial crisis, that has led to what is called generational disparities and an increase in the divide for different classes, socioeconomic classes of people in the U.S. And it's absolutely true. It's absolutely true. Now, the problem I have is that Scott Bessent talks out of both sides of his mouth, right? He blasts the Fed in this article, in this op-ed that he had, and I'll include a link to Wolf Street's article, because the Wall Street Journal is behind a paywall. And I know that most of you guys maybe don't have a Wall Street Journal membership. I don't either. I don't bother because the information is much better on Wolf Street and it's free. So go to Wolf Street to read this article, but he does a great job of summarizing the op-ed. And basically, here are some of the comments from Scott Bessent's essay about how the Fed screwed up over the last 15 to 18 years. It's something I've talked about too in the past. The extraordinary monetary policy tools, quantitative easing, which is the lowering of interest rate, and ZIRP, zero interest rate policy, unleashed after the 2008 financial crisis have similarly transformed the Federal Reserve's policy regime with unpredictable consequences. Successive interventions during and after the financial crisis created what amounted to be a de facto backstop for asset owners. The Fed got away from what their primary purpose is, which is monetary policy. They became a bailout machine, is basically what Scott Bessent is talking about. We just saw it last year during the Silicon Valley bank implosion. Instead of letting free markets let the bank implode, the Fed basically acted as a backstop and they bailed out a lot of people, which is what they should not have done. Now, you can make an argument that during the 2008 financial crisis, the Fed had to act because our monetary system was frozen during that time. So the 2008 financial crisis, I think there were some instances where they had to act, but they started bailing out banks. They started bailing out General Motors. They started bailing out all of these different entities and corporations, and they got away from what their primary purpose really is. It's to control inflation, handle monetary policy, and handle monetary supply to keep the economy humming, to keep the economy going and growing. And because they got away from it, because they became a bailout machine, as I like to call it, that's just something I made up, it's created a huge disparity between those that own assets and those that don't, but would like to own assets. You hear all the time in the mainstream media about how 25 to 35-year-olds, I don't know what it is, what generation it is, Generation Z or Generation, the millennials. A lot of people got screwed who are not homeowners that would like to be homeowners, but because housing prices have inflated so much and we are now paying the price for all of that ZIRP by having higher interest rates and more historically normal interest rates that people can't afford to buy a house right now. So that's really the broad summary. There's lots of other stuff in there, but homeowners saw their property values soar, largely insulated by fixed rate mortgages. That's what a lot of people have had. But the younger, less affluent households, they're shut out of home ownership and hit hardest by inflation. And they missed out on all that homeowner appreciation. They have to continue to pay rent. Now they're hit hard by current and the last 18 months of high inflation. So they're getting hammered on both ends in terms of their overall net worth. So a lot of that's true. But the problem I have with Scott Bessent, to go to back to my original point, is he and his administration, they're calling for the Fed to lower rates right now when inflation has not been stamped out. So I do think that while he's correct in this op-ed, he's also talking out of the other side of his mouth by helping to try and push the Fed to lower interest rates right now, when I would argue that interest rates are perfectly fine right where they are. We're probably going to see a cut in the federal funds rate here by the Fed mid-month. I think they meet the 15th or the 17th, the Fed does. And the market's already pricing in at least one more rate cut. And what could happen is inflation's going to come right back into action. So that was interesting. But, here's a historical chart of where the Fed has kept the federal funds rate, the interest rate that the Fed controls, the short-term lending rate. And you can see that obviously during the 80s, we had massive inflation. And so Paul Volcker, I don't know how you pronounce his name properly, Volcker, he correctly kept interest rates by the Fed historically high because he had to stamp out inflation. And it was painful. And there was a lot of economic hardship across everybody as he kept these interest rates high. Mortgage rates were obviously even higher, but eventually he was able to stamp out inflation. Well, since then, we had Alan Greenspan, who lowered rates and lowered rates and lowered rates, and we had some good times. Obviously, during the internet bubble bursting in early 2000, that's when things went off the rails, and we lowered them and lowered them even more, started raising them back up again, and then '08 happened. Well, 2008 was a long time ago, right? That was 17 years ago now. And instead of raising the interest rate back up to normal once we got through the 2008 financial crisis, they kept it at zero. So Ben Bernanke and Janet Yellen, they both deserve a lot of the blame as to where we are right now with higher inflation, really high asset prices, and unfortunately, when you have housing prices that are super inflated, they've gone up dramatically over the last 5 to 6 years alone, but even dating back to 2012, because they have not decided to raise rates back to an historical normal rate of 5-ish%, which is where we're at right now. They waited too long. And now we're paying the piper. And so if you look at Ben Bernanke's, some of his past comments about the wealth effect, he was always super positive about the wealth effect. He's like, we got to keep doing quantitative easing, ZIRP, zero interest rate policy, because he was very gung-ho about the wealth effect and how it's going to spur spending and increase consumer wealth and confidence and higher asset prices. All of those, he's had numerous times where he's been cited. He explicitly called it a virtuous cycle in a November 2010 Washington Post op-ed. So I think my argument is it's a virtuous cycle when everyone's making that money. It's a virtuous cycle if you've already got the assets. If you don't have the assets, what happens at the end of that virtuous cycle, there's people that have and there's people that have not. And I'll show you a chart supporting that in a second. But Ben Bernanke, he's absolutely somebody who is pro wealth effect. And there are some benefits, as we've just talked about, but there are also some negatives. And I think that Janet Yellen, who was the succeeding federal chairman, she was selected by Obama. Ben Bernanke was selected by Bush Jr. as the federal chairman. So it's not a Republican versus Democrat thing, okay? This is a problem for both parties. Bernanke was selected by Bush Jr., and Janet Yellen was selected by Obama. They both extolled the virtues of the wealth effect. And I do think that there is a little bit of revisionist history going on right now in the mainstream media, because while she does talk about some of the negatives of the wealth effect. And for example, in 2014, while discussing economic opportunity, she acknowledged that the Fed's quantitative easing policies, or zero interest rate policies, by boosting stock and bond prices, mainly benefited the wealthy. She noted that the wealthiest 5% of Americans own 2/3 of all financial assets, and how it created wealth inequality. Well, that's fine. That was in 2014. Let's go back again to that chart. And so, again, during her tenure, she basically kept rates the same. She basically continued Ben Bernanke's zero interest rate policy. And I guess my point is that she talks a big game about the inequalities of, that kind of thing, but she didn't do anything about it. She kept it at zero. So she's just as guilty, even though she talked a big game. And again, I do think that the mainstream media likes to revise how people are portrayed historically. And they're doing that, I think, right now with Janet Yellen. Do you remember what Janet Yellen said during the very beginning of the inflation, the huge inflation that we saw starting in 2020 through 2022? She said it was transitory. Do y'all remember that? I even made a video about that and how she said it was transitory and how I laughed about that and how I was like, this is not transitory. This is just the beginning. And I made that video, but I think it was I don't remember exactly when. It was in the fall of 2021-ish, somewhere in there. And somewhere around that time frame, she said it was that inflation's transitory. There's nothing to worry about. Well, it went on for another 6 to 9 months of massive inflation, and she did nothing about it. So I don't think that what the mainstream media is trying to do in terms of making her look better and how she was disparaging the wealth effect, I don't think it really works because of what she actually did. Look at what they did, not what they said, right? So again, there are lots of negatives related to the wealth effect. And I think you're starting to see the repercussions of what the last two federal chairmen did, just the last two, really. You get amplified economic cycles, right? Where you have a boom and bust type of cycle. I would argue we're still in the boom right now. A lot of it's was driven by this quantitative easing by the Fed. A lot of it is also being driven by the artificial intelligence bubble, question mark, or not. Who knows? Maybe we're entering the next golden age for mankind and we never have the bubble burst. But based on valuations, you could make the argument that we're in the middle of a bubble right now. And so during the market upswing, you see increased spending and that kind of thing. But the other big problem is number two, is increased inflation. And we're going to show you a chart of the US dollar versus the euro in a second here. But higher consumer spending across the economy can drive up inflation, leading to higher prices and potentially forcing central banks to increase the interest rates, which can slow down the economy. That's where we are right now. The Fed finally realized that inflation is getting out of control. We got to raise the rates. Well, now they're already talking about lowering rates, but inflation has not been beaten yet. It's mind-blowing to me that we're talking about lowering rates right now when unemployment is still at historical lows right now. So it's pretty wild. The other big thing that I don't even know if I even touch on this. Maybe I do. Let's see. Yeah, it doesn't really touch on in the AI thing. But the other big thing that I think the wealth effect has caused, and specifically a more active Fed has caused, getting away from their primary purpose, which again, I'll remind you, is controlling inflation and monetary supply. Keeping the money supply, the amount of money that's out there, in line with demand, so we don't have inflation, right? But I think the other big thing that the Fed has basically caused is that it's created perverse incentives in the market, because the market knows, based on recent history dating back to the 2008 financial crisis, the market knows the Fed is going to bail them out. So it creates perverse incentives to take more risks. And obviously we saw that during the '08 recession, where banks were acting irresponsibly with garbage mortgage-backed securities and selling them off as AAA securities. Well, when you know that the Fed is going to be willing to bail you out in the event of another financial crisis, which is when, not if, it creates like a perverse incentive. And when left alone, banks are going to be self-serving. They're going to be greedy. They're going to be self-serving. They're going to take unnecessary risks to improve their bonus structure at the end of the year, because they know the Fed's going to bail them out. So the Fed has got to get back to doing what their primary purpose is, and letting the general economic forces decide the winners and the losers. Let the banks fail. Obviously, you have federal deposit insurance for the consumer, but the banks and the stockholders in those banks that make stupid decisions that end up costing the bank, solvency, they should be let. The Fed should let them die, is basically what I'm saying. And, last year's Silicon Valley, they acted as another backstop for them when they should have just let them die, let those shareholders eat their loss, let those employees go find new jobs. Obviously, the FDIC is there to protect the actual deposits. And I think that's a good thing that came out of the New Deal from FDR. But I just think that you've got to let the economy and the economic forces decide the winners and the losers and not create incentives to do stupid risk taking. In terms of personal finance, I think this is a really good summary of what the risks of the wealth effect. A false sense of security. Consumers, again, the idea of the wealth effect is that you haven't really changed how much income you're making. Your paycheck hasn't changed, but it creates a false sense of security is that I'm wealthy. Look at all these paper gains I've got in real estate and stocks. I can go spend more than I should instead of saving. Excessive borrowing is another one. And again, that is really tied to what I just talked about with these perverse behavior incentives that the Fed has created. Excessive borrowing is by the consumer, by the everyday American, is another negative perverse effect of that. Liquidation of assets. You might start selling off some of your liquid assets to fund your consumption instead of being a long-term saver. Or the liquidation of non-liquid assets like real estate. For me, the way it's always hard to decide when to sell something, right? It's hard. It's really hard. I mean, I did it with my collection. I did it with my office building in 2023, but it comes down to timing and making the most informed decision and deciding on what are the alternatives. Should I have shelves of little plastic dolls inside acrylic carbonite, or should I have that money saved in 529 plans for my for college for my kids and for my half sisters? I decided that was the better decision. So anyway, I think that a lot of these negatives that I have up here for personal finance for the everyday American are absolutely true as a result of the wealth effect. And what's happened? Well, things have come home to roost now. And while Janet Yellen talked about the income inequality from the wealthy versus the lowest, she didn't do anything about it. And what we're seeing here is, remember, the recession, the Great Recession of '08 was right at almost the peak of what the percent of ownership of the bottom 50% of Americans. What happened after that? Zero interest rate policy took hold with the Fed, and they didn't move off of it for 17 years. And what happened as a result? Those with assets enjoyed those gains. Those without assets, it became that much harder to get the American dream, to own your own house, to have a 401k, whatever it is. And as a result, the bottom 50% of America, they went from owning 8% of total assets to owning 5.9%. While that doesn't sound like a huge number, from a percentage change, that's a huge drop. That's a huge drop, and it's near all-time lows. So this is what you reap by having zero interest rate policy after the 2008 financial crisis was more or less calmed down and solved. Instead of getting back to normal, they kept it low for an extended period, and this is what you get. And now we're at the phase of the US dollar on a global perspective is not trusted. Look at what the US dollar has done versus, I just picked a random one. I picked euro, but at the end of this year, they were basically even, more or less. It was for every 1 year, for every 1 euro, you had to spend $1.03 ish, somewhere in that ballpark. Look at what it's at to now. You're basically up to $1.18. This is in 9 months, folks. 9 months. We've lost, let's call that 15%, between 10 and 15% of the US dollar's purchasing power relative to the euro. You can do it with pretty much any other currency. It's going to show you the same numbers. So we are at that phase right now where you effed around and now we're finding out. So, we'll see what happens from here. But, again, the Fed is talking about lowering rates in roughly 10 days or less. And they might even do it one more time. And again, we're at historically low unemployment right now. The Fed has got away from its job of controlling inflation, and they are now basically trying to remove business downturns from the U.S. economy completely. And you can't do that. A healthy economy has peaks and valleys, has peaks and valleys, because it weeds out the losers. It weeds out the people that took too much risk, that took on too much debt, and it rewards the winners, the ones that saved, and the ones that made good business decisions. And I'm talking about from a corporate perspective right now. So anyway, I just think that this was an interesting article, and I'll again go back and read this Wolf Street and make sure to sign up for his newsletter. It's the best on the web in terms of economic data. But I talked way too long in this one, and again, if no one watches this video, then we will not do it anymore. But thanks for those of you that stuck around this long.